Hello everybody. So today a quick video on 5 stocks that I like very much right now, but that unfortunately I haven't had a chance to buy too much of, aside from HIMS yesterday quite a bit. Haven't had a chance to buy it because of course Tesla is dirt cheap right now, and Bitcoin and especially some proxies like some miners and MicroStrategy are very cheap right now. So don't forget as I go through this stock that my number 1 and 2 position, number one is respectively Bitcoin and related proxies, and number 2 is Tesla. And in my style of investing, I also try to look at value growth, like both value and growth, cheap growth. And so what I want to talk about today is 5 stocks that I consider to be hyper growth as well as highly inexpensive. And surely enough, if you look at enterprise value over sales for all of these, you can see, they're all even cheaper than Tesla on a price to sales basis here. Pretty darn cheap. As a comparison, for example, if you look at a SaaS company like a CrowdStrike is close to a 20 right now on a price to sales. So this gives you an idea when you look at a company like HIMS, for example, that has a free, or a Shift4 Payments company with an enterprise value over sales of 2. That's the ratio. That's pretty dirt cheap. These stocks are largely hated by the market. I don't know why, but we'll go through them. And that's part of my style of investing. And also, why do I care about revenue growth? Well, I want my stocks to outpace monetary inflation, i.e., as the dollar gets printed more and more, and we have no choice, even if we all gave all of our money to the government, there still wouldn't be enough money. We have no choice. Monetary printing, monetary expansion is the only way. That's how Keynesian economics works. We have no choice. Companies, if they want to remain afloat, if they want to stay valuable, they have to grow at least at the rate of monetary growth, at least at the rate of the money stock. And the big debate is, how quickly does the money stock grow? Well, in my estimate, it's about 15%, 15% per year is what the money stock growth is. It's not as low as, say, the M1 would have you believe right now, because the M2 monetary mass, not M1, M2 monetary mass would have you believe right now. It's not that low. It's much lower than that, because, of course, the US dollar financial system, as its granddaddy, if I'm going to call it that, which is called the euro dollar system, which is even bigger than the M2 US financial system dollars in circulation. Either way, they're both growing exponentially. So the stocks that I invest in, they have to capture that extra share of new dollars being issued each year. And that's why I want them to grow at least at 15%. And ideally more than 30% revenue growth, ideally would be the target that I look at. So let me get started. Without further ado, let's talk about SoFi. So SoFi is a stock that I've covered since the early days of the channel. The stock's always been cheap. I've always known this stock to be cheap. It's back at $7-ish. So pretty cheap. They have done a convertible note recently, raised some capital, and I remember a few months back, they had predicted low growth numbers because they were counting on just a few rate hikes in 2024. Well, it turns out SoFi was right. We're not going to have that many rate hikes. They were right to guide prudently at only 22% growth. By the way, that's the analyst's estimate here, right? That's not what they guided. They actually guided a little lower than that. But the analyst estimates at 22% growth. So they're still going to grow, but mostly in the technology services sector, much less in the loan sector. But don't forget, for banking, banks can grow as fast as they want, provided the level of risk they want to take, because everybody wants to borrow money. So if a bank is willing to take crazy amount of risks, it can grow crazy fast. Clearly, SoFi is not deciding to take very high amount of risks today. They are conservatively managed. If I look at my price, my enterprise value over gross profit over revenue growth, that's kind of a signature metric of the channel here. This is a spin on the PEG ratio. This is a slightly modified PEG ratio where instead of market cap, i.e. price, instead of that I use enterprise value because I want to penalize my companies when they have debt. Instead of using earnings, earnings can be manipulated left and right. You have discretionary accruals all over the place. Instead of that, I use gross profit. I estimate that gross profit is the best long-term estimation of what the economic profitability of the firm is. That's why I love gross profit. And then I use revenue growth as opposed to earnings growth. Revenue growth here is used as a proxy for gross profit growth because gross profit over time doesn't really change that much. It's revenue growth that changes. So you get a number just like the PEG ratio, except it's typically twice as small as the PEG ratio. So anything under 0.5 is considered very good in my spreadsheet. SoFi at 0.25 is excellent. It is, let's call it first quarter cheapest stock. And what I've added recently, what I love about SoFi is that EBITDA margin at 30%. Take note how it's the highest EBITDA margin of the 5 stocks I have. I've added EBITDA margin recently, really over the past 6 months in the spreadsheet to use what VCs use to assess whether they want to invest in a company or not, which is called the rule of 40. So the rule of 40 says that the profit margin, and staying consistent with myself, I use EBITDA as a proxy for profit margin because I believe earnings are vastly manipulated by companies. So I use EBITDA as a proxy for profit margin. If you add that margin, that EBITDA margin, to the revenue growth, both of them added up should be more than 40%. So essentially what that means is if a company makes no breaks even, just breaks even but has no margin, if a company makes no money, it should grow at 40%. Or if a company makes a 40% EBITDA margin, it can get away with growing at 0%. This is essentially what the rule of 40 is telling you. All of these stocks handsomely beat the rule of 40, and I invite you to look at a screener and see how many stocks actually beat the rule of 40. It is not that obvious. I go through hundreds of stocks. Stocks are my passion. It's my hobby. I go through hundreds and hundreds of stocks. It is not that easy to find a stock that achieves the rule of 40. That's why these companies, I firmly believe, are special. And I should note, I own all of these companies, right? Some in bigger positions than others. SoFi, Mercado Libre, and HIMS are all roughly 5% position for me. Actually, HIMS is a little bit more than a 5% position. Odd as well. That's Oddity Holdings, Oddity Tech, as well as Shift4. Those are starter position, about 1%. I'm increasing my position in those. But I believe in these companies. I just wish Tesla was back at 200. That way I can focus on buying these stocks. But if Tesla is at 160, I'm going to be buying Tesla. If Bitcoin is at 62,000, I'm going to be buying Bitcoin, especially with a halving coming. So kind of sucks to see these cheap prices, but can't take advantage of them as much as I want to because of my highest conviction positions, which are Tesla and Bitcoin, the positions on which I have done the most research. For Bitcoin, it is well over 10,000 hours. For Tesla, thousands and thousands of hours. Those stocks are cheap, so I'm focusing on the winners, focusing on those who have been winning in the past and continue winning. But I want to buy these. I want to get exposure to these. Anyways, enough talk here. Let me move on to Mercado Libre. So Mercado Libre, you may know that Amazon is not doing too well in Latin America. It's not doing too well in Mexico. It's not doing too well in Brazil. No, the company that's doing well in Latin America is called Mercado Libre. It is this Brazilian company who has cracked the code of Latin American e-commerce. If you look at Mercado Libre, they're still predicted to grow 27% next 12 months from a very high base. Take note of the base here at $14 billion. That's a very high base in revenue upon which they're growing at 27%. So what that tells you is that they're earlier on in the e-commerce adoption over there. E-commerce adoption is more nascent over there, which means they're growing faster than, say, an Amazon. Amazon grows at 11% revenue growth for Amazon, right? So not quite 3 times as high, but almost 3 times as high. As soon as the economy recovers, I have no doubt they'll get to still 3 times as high as Amazon. The gross margin is excellent at 58%, and they've developed, of course, their own delivery network. They have their website. They have a fintech, which Amazon doesn't have a fintech associated with it. They follow the Asian business model of these e-commerce platforms with their fintech, which is actually the reason why the stock was down a little bit. The market was a little fearful about some stuff with their fintech. Mercado Libre, I want to point out also their outstanding performance in Argentina. Not an easy market to perform in, and they've been doing very well in Argentina. Anyways, why do I love Mercado Libre? For a company that is, in my view, as steady Eddie as it gets. I mean, Mercado Libre is a company you'd have a hard time finding someone disagreeing with you on that investment. It's perhaps the most consensus investment I can find. Right? It's like me telling you I like Microsoft. Right? I mean, as far as this channel gets, this will be the most consensus stock I will ever show on this channel. Mercado Libre, very consensus company. It's in the Nasdaq, it's in the Triple Q. I mean, stable stock, high stock price. What's not to love? And I love it very much at these prices. I'm covering it because it went down towards $1,400 a share. It was trading in the $1,700 shares not too long ago. So it is a deal again, and I'm buying profitable, high growth, great market that I like to have exposure to. Now, moving on to a new stock. So you may remember that I've covered this stock on the channel before, and the little bit that I covered it, I wasn't too hot on it. Why? Because it was supposed to be an acquisition target, and a lot of people were buying this stock because they were hoping it would get acquired. And of course, I ran away from this type of stock because I want to own a stock for 10 years. If I'm going to invest dozens of hours of research just to start a position in a stock, and granted, this is a sector I'm familiar with, so let's call it 10 hours of research. I've been following this stock for about, a good 6 months already. If I'm going to invest the time, I don't want the company to be bought out, right? I mean, one of the unfortunate stocks I had covered on the channel was that dog walking stock, Rover. Well, it got acquired by some VC. Yeah, amazing. Made 30% on the stock. Isn't that great? Like, who cares? It's not what I invest for. I want to own the stock for the long run. It seems like the CEO has decided to not sell the company, which means I'm happy, which means I'm back in. And I'm buying this company. So revenue growth is predicted to be 34%. It's a company in the payments space. Think of it as a competitor to Square's payments terminal. So a competitor to those, but for larger businesses, right? They really compete against the terminals that are put out by the banks, like the Clovers of the world is what they compete against. Very popular with big companies. They win a lot of big deals with larger companies, and you may see it in various places across the US. This is definitely one of the more popular payment system. Anyways, predicted to go at 34%. The stock is dirt cheap. That is dirt cheap. Cheaper than HIMS. Cheaper than HIMS. Believe this. It's cheaper than HIMS. How crazy is that? So, 2 times trading enterprise value over sales, 2x, 2 times sales. That with a gross margin of 69%, within an EBITDA margin of 13%. So we get well above the rule of 40 out of 47. So that's great. And that's a 0.092. So how much am I paying for each percentage point of forward growth here, each 1%, well, I'm paying 0.092. So you can see that future growth in Shift4 is dirt cheap. And that's what I love in a stock. Love to buy it, love to see it, love to see the growth at Shift4 to still be strong and not dropping like, say, StoneCo, which is another stock that I like, that I still own, that I still believe in. But StoneCo, if you follow Stonier, it seems to be becoming more of a bottom line type play. I'm not as comfortable with those because I know how easily bottom lines can be manipulated with buybacks and all sorts of accounting treatments. So anyways, I like to see top line growth for a company like Shift4. I am building my position. If only Tesla went up, that way I would have a reason to not buy Tesla. I've made the decision today that I'm not buying Tesla anymore if it's more than 161 per share. So That will be easy tomorrow. If Tesla moves up to say 165, I won't be buying Tesla. I'll be shifting to some of these other positions, trying to diversify a little bit, although historically I've been a horrible diversifier. I've always been concentrating on the winners. But anyways, moving on to another company, which is Oddity. So Oddity. So you may know about Oddity under another name. It's called Il Makiage. It's an old brand that they recuperated. And you may be more familiar with Unity, actually, if you're a woman, because this is a cosmetics brand, right? So this is a cosmetics brand. They focus on foundation. That's the main product, Il Makiage, and it's using AI to sell a foundation to a makeup user, right? So why is that a great business? Well, it's a great business because it's very hard for women to find the exact foundation for the color of their skin. There's literally millions of possible tones for skin. Tons of different tones, and of course, legacy player in the makeup industry. Well, if you operate in a regular store, you're going to have, 30 tones? So that doesn't really work. And so women had to settle for the closest foundation they could find. Now they don't have to do that anymore. They can have this company, Il Makiage, scan their face, come up with a special formulation just for their skin tone, and it creates a recurring revenue business where as soon as women have used up the foundation, they order it again because they found their perfect color match. So that's the business in a nutshell. They have a smaller division called Spoiled Child, which is them trying to replicate the same success, but for dermatology and for skin issues. Anyways, the stock is dirt cheap at a 0.15. How much am I paying for that growth? I'm paying 0.15. That's dirt cheap. It's predicted to grow at 33%, so more than 30%, more than my historical threshold, and it's already profitable, EBITDA margin at 20%. And that's the highest Rule of 40 stock that I have out of 5 stocks that I covered today at 53%. The big risk for Oddity, oddly enough, the big risk is that it's in Israel and it's the type of stock that can be volatile for the very reason that it is in Israel. It's more volatile because it's subject to the geopolitical conflict. I've had that same issue with another stock that I own, which is InMode. So always keep that in mind. You can have swifter movements, more volatility on a stock that is located in Israel. At least it seems to have been the case yesterday. So anyways, not their fault. That's they are located where they are located. But moving on to a company located in the US who doesn't have these problems, and this company is HIMS, and I love HIMS very much. I have covered HIMS for well over a year now on the channel. Started covering it about $6. And then we've been through the roller coaster, and now HIMS is cheap again at $13. Remember it had ran past $15. So at 13, you have a nice little discount right now for HIMS. I bought yesterday, planning on buying again if it keeps dropping and increasing my position. I'm comfortable owning more than 5% of HIMS. It's a business that I know enough by virtue of having covered it for a long time on the channel. What does HIMS do? HIMS tries to revolutionize healthcare. They're an e-doctor plus an e-pharmacy together in one product, easily priced. You know the cost up front of the drug if you are prescribed the drug, and you know the cost up front of the doctor visit, which is usually embedded in the monthly fee if you are prescribed the drug. HIMS is revolutionizing pharmacies, right? And to a lesser extent, the more profitable procedures that doctors would do. Like the more profitable procedures of doctors, they're kind of going after that. They're not going after the harder stuff, but the easy stuff, like the customer walks in and, they're in their 40s, maybe a little overweight, and they have an ED problem, right? Easy money, easy visit. That's the kind of thing that HIMS covers for now. And I'm not saying that they won't cover more in the future, but for now they focus on the low-hanging fruit. And they've been doing very well. Predicted to grow at 41% over the next 12 months. They're highly profitable at 82%. Keep in mind that revenue, more than 90% of that revenue is recurring, which means they do not have to fight for each sell, which is a big deal. You start the new year with a base that is already acquired to the cause and that is already on a recurring payment basis. And of course, a stock like HIMS, but this is true of many of these stocks, such as Oddity, right, for cosmetics, and SoFi. These three stocks, they're subject to cross-selling. So HIMS obviously is going to have cross-selling. Right now, the average HIMS user has 1.5 products. The question is, once, say, they have, right now they have a little more than 1 million customers. Say when they have 10 million customers, are they going to start doing cross-selling? And then all of a sudden you may have 10 million customers, but if you sell 3 treatments on average to your 10 million customers, you really have 3 times 10, so 30 million subscriptions. So that's why this is a company, when you do the math, you can quickly get to more than a 10-bagger. And with a little imagination and hope and perhaps bad luck for the traditional pharmacies, I can model, long enough, I can model 100x. I mean, it's not that far-fetched to model 100x long enough. If you look far out into the future for a stock like HIMS, say 15 years. Because remember, pharmacies are getting disrupted. HIMS really, the best way to look at it is an e-pharmacy, because the visit on HIMS.com, that visit is provided more as a courtesy, really. I mean, it's a loss leader for HIMS, that visit. It's really more of a pharmacy, and ask yourself a question, always thinking on first principles basis, do we really need 45,000 pharmacies in the era of 2 to 5 hour shipping for 95% of the population, right? And we do that on tens of millions of SKUs. The pharmacy is just a few thousand SKUs. It's not tens of millions of SKUs. So I have no doubt to imagine that you're gonna have maybe half a dozen, maybe a dozen digital pharmacies that are just gonna replace legacy pharmacies who have to pay for this crazy infrastructure, for this crazy physical buildings. I mean, and that's why pharmacies, if you ask me, in the US, pharmacies have already stopped making sense. I mean, you walk into a pharmacy, you can get ice cream and chocolate and wine. It's almost, I mean, I could almost make a case. It's a little unethical. You walk into a pharmacy to get like a drug prescription, and you get sold chocolate and ice cream, right? So anyways, so HIMS doesn't sell any chocolate or ice cream, which is kind of why, I mean, I think it's a 0 to 1 business. Many of these actually, I believe, are 0 to 1 business. Obviously not a payments company. That's not a 0 to 1 business. But say a Mercado Libre in its day was a 0 to 1 business. Today, Odd and HIMS would clearly be 0 to 1 businesses, really new to the market, new products, right? Not just an incremental improvement, not just a spin, something truly new. And that is why they are having these high growth rates, whether it is Odd and HIMS. Happy to own both. HIMS is my biggest position out of all of the stocks covered today. HIMS is my biggest position, and these are the stocks on my watch list, right? So hopefully Tesla goes back up tomorrow so I don't have to buy Tesla. And thank you for watching. This was not investment advice. This is not financial advice. This is just entertainment. I'm hoping you were entertained. Please like, please subscribe. Follow me on X if you can. I always appreciate it. Thanks for watching. Have a wonderful day.